Hello and welcome back. In our next session together, we're going to explore the essential metrics that help us understand profitability when it comes to real estate. Because profitability is such a comprehensive and important subject, we'll be breaking this training down into three manageable modules. Each module will offer a unique viewpoint on profitability, and in each one, we'll delve deeper into the key metrics that apply to that specific aspect. We'll look at accounting and financial metrics. These help us see how well a company is performing in its operations. We get this information from financial statements. Examples include gross profit margin and net profit margin. Return metrics. These measure how profitable different investments are. This includes metrics like return on equity and return on investment. Valuation metrics. These focus on the current and future value of your assets and investments. We'll use methods like net present value and discounted cash flow to see if an investment makes economic sense. Let's continue mastering real estate metrics. Module 1, Accounting and Financial Metrics. Welcome to Module 1. In this module, you will be able to explain and use key accounting and financial metrics to analyze the financial performance of a real estate company or investment. You'll learn how to calculate these metrics and understand what they tell you about profitability and operational efficiency. So, what exactly are accounting and financial metrics? These are quantitative tools we use to check out the financial performance of a company. The information we need comes straight from its financial statements. Why are they so important, you might ask? Well, these metrics give us really good insights into how profitable a company is, how efficiently it's running its operations, and what its cost structure looks like. Ultimately, they help investors and managers make smarter, more informed decisions. In this first part of our course, we're going to talk about three main metrics: gross profit margin, operating profit margin, net profit margin. Let's dive into the first one. Gross profit margin. What is gross profit margin? Gross profit margin is a financial metric that shows the percentage of gross profit a company makes from its total revenue. Think of it this way. It tells us how many cents of every dollar in revenue are left after the company pays for the cost of goods sold. Why is gross profit margin important? There are a few key reasons. Profitability assessment. It's a big one for checking profitability. A higher gross profit margin means the company is more profitable. It shows how efficient the company is at making its products or delivering its services and how well it's pricing them. Business comparison. This metric is super useful for comparing similar businesses in the same industry. It helps investors and managers see how their business is stacking up against competitors. Are they doing better? Or are there areas where they might have a disadvantage? Trend analysis. By tracking the gross profit margin over time, you can get clues about how efficiently the business is operating. For example, if you see the gross profit margin going down, it might signal problems with pricing strategies or rising production costs. How do we calculate gross profit margin? The formula is gross profit margin equals gross profit divided by revenue multiplied by 100. Let's break that down into simple steps. Gross profit equals revenue minus cost of goods sold. Take that gross profit figure and divide it by the total revenue. Multiply your result by 100 to get the gross profit margin as a percentage. How does this apply to the real estate world? It's actually very relevant in several scenarios. For development projects, real estate developers and contractors want to see how profitable their projects are. Here, the cost of goods sold includes direct construction costs, raw materials, labor for contractors, and other direct costs directly tied to building the property. Revenues in this case come from selling the finished properties or units in the project. Next, for income-generating real estate, like an Airbnb apartment or bigger properties such as office buildings or shopping centers, the gross profit margin is a good way to check profitability before you count other operating costs. In this situation, what we call cost of goods sold would mainly be the ongoing and direct maintenance costs for the properties. Revenues simply come from the rent collected from tenants. Lastly, in value add transactions, also known as flips, the plan is to buy properties, improve them, and then sell them for a profit. For these deals, the cost of goods sold is the original purchase price of the property plus all direct costs that happen when improving and fixing up the property, like materials, labor, and any needed permits. Revenues are the selling price you get for the property after the improvements are done. Let's make this concrete with an example. Imagine a developer is working on a project. The developer plans to build 20 units and sell each for $2 million. So, expected revenues are 20 units multiplied by $2 million per unit, which equals $40 million. Cost of goods sold, the cost for construction, land, permits, and fees add up to $31 million. Now let's calculate the gross profit and then the gross profit margin. Gross profit, this is revenues minus cost of goods sold. So $40 million minus $31 million equals $9 million. Gross profit margin, this is gross profit divided by revenues multiplied by 100. So $9 million divided by $40 million multiplied by 100 equals 22.5%. What does this 22.5% mean? It means that for every dollar of revenue this project brings in, the developer earns 22.5 cents in gross profit. This figure tells us about the project's profitability before we take out other expenses like marketing, financing costs, or taxes. Now that we understand gross profit margin, let's consider what happens when we account for more of the daily business costs. Operating profit margin. We've talked about what's left after the direct costs of production, but what about the other costs of running a business day to day, like salaries, rent for office space, or marketing expenses? That's where the operating profit margin comes in. What is operating profit margin? Operating profit margin is another key financial metric. It shows the percentage of operating profit a company earns from its total revenue. Why is operating profit margin important? This metric is crucial for several reasons. Evaluating operational efficiency. A higher operating profit margin generally means the company is more efficient in its core operations. It tells you how many cents of every dollar in revenue are left after paying for both the cost of goods sold and the company's operating expenses, like salaries, rent, and marketing. Comparing businesses, just like gross profit margin, you can use operating profit margin to compare similar businesses within the same industry. It gives investors and managers a good sense of how the business stacks up against competitors in terms of how well it manages its overall operations to generate profit. Analyzing trends. Tracking this margin over time can provide insights into how the business's operational efficiency is changing. For instance, an improvement in the operating profit margin usually indicates that the company is getting better at managing its costs. How do we calculate operating profit margin? The formula is operating profit margin equals operating profit divided by revenue multiplied by 100. Let's break this calculation down. Operating profit equals revenues minus cost of goods sold minus operating expenses. Take the operating profit and divide it by the total revenues. Multiply that result by 100 to express the operating profit margin as a percentage. Let's look at an example for an income-producing property, say an office building. Annual revenue. The building generates $5 million from rent. Costs and expenses. The annual costs for maintenance, management, insurance, property taxes, and utilities come to $2,100,000. Let's calculate the operating profit and the operating profit margin. Operating profit, this would be revenue less costs and expenses. So $5 million minus $2,100,000 equals $2,900,000. Operating profit margin, $2,900,000 divided by $5 million multiplied by 100 equals 58%. A 58% operating profit margin means that for every dollar of revenue the office building generates, the company earns 58 cents after deducting the costs and all its operating expenses. This shows a strong ability to manage the property's operational costs relative to its income. Now, we've looked at profit after direct costs and profit after operational costs. What about the very bottom line after everything is paid? Net profit margin. We've peeled back a couple of layers of profit, but what's the ultimate measure of a company's profitability? How much money does it actually keep after every single expense has been paid, including taxes and interest on loans? This brings us to the net profit margin. What is net profit margin? Net profit margin is a financial metric that shows the net profit as a percentage of total revenue. Think of it this way. This metric tells you exactly how much money a company truly pockets for every dollar of revenue it earns once all its expenses are accounted for. This includes cost of goods sold, operating expenses, taxes, and interest payments on debt. Why is net profit margin important? A high net profit margin is a strong indicator of higher profitability. This metric reflects how efficient a company is at managing all its expenses from top to bottom. It also allows for a very good comparison of overall profitability between different companies in the same industry. How do we calculate net profit margin? The formula is net profit margin equals net profit divided by net revenue multiplied by 100. Let's use some simple numbers to see this in action. Net revenues. A company has total revenues of $1 million. Net profit. After deducting all expenses, the company's net profit is $100,000. Now let's calculate the net profit margin. Net profit margin. $100,000 net profit divided by $1 million net revenues multiplied by 100 equals 10%. What does this 10% mean? It means that for every dollar of revenue the company generates, it retains 10 cents as net profit after all costs and expenses have been covered. This is the bottom line profitability. Beyond just giving us that final profitability number, net profit margin is useful in other ways too. Trend analysis. It's used to analyze how a company's profitability is trending over time. If you see the net profit margin increasing, it often indicates that the company is improving its operational efficiency or perhaps has stronger pricing power in the market. Investment evaluation. Investors use this metric to evaluate a company's potential for profit. Companies with consistently high net profit margins can be seen as having a significant competitive advantage and good potential for future growth. So these three margins, gross, operating, and net, give us a progressively clearer picture of a company's profitability at different stages.